Hi, I'm Campbell Harvey. I'm professor of finance at Duke University's Fuqua School of Business. And what I'd like to do today is mainly take your questions. So you can actually put questions in the comment section and they will pop up and I'll see them. And the topic today is to try to navigate what's going on with financial markets. It is a very strange situation where we see a historic drop in the second quarter in GDP. So by historic, I mean that before this time, in terms of modern GDP accounting, which began in 1947, the largest drop in annualized GDP was 10%. And then we see the number for the second quarter being more than triple that. We've seen a record unemployment. We've got over 30 million people unemployed. And don't go by the number that's actually published, the headline number. That's just not accurate because it doesn't count the number of people that are unemployed and on other types of assistance. So the pandemic assistance. So it's actually in the data. And it's 30.2 million people. You do the calculation, that unemployment rate is 19%, not the headline number. Okay, so we're in a situation where the economy's in a free fall. We've got unemployment to the tune that we haven't seen since the Great Depression. Yet, you look at the financial markets and you wouldn't know. The financial markets are essentially pricing a V-shaped recovery. And if you follow me on LinkedIn, you know that I don't believe in a V-shaped recovery. I do think that this recession will be short because it will be ended by the deployment of a vaccine, but it's not a V-shaped recovery. So what is the disconnect? So that's what I'd like to explore today. And to be clear, I'm not here to give investment advice. I don't do that in the classroom at Duke University, and I'm not going to do it on LinkedIn. I will give you what I think are some insights and try to figure out what exactly is going on. So first thing is the market. And how is it possible that the market is essentially ignoring this economic carnage? So one thing you have to do is to look kind of beyond the headline number. And this is really interesting. So if you look at the top 10 tech stocks, they're up 36% to date over the year. So if you look at the other 490 stocks in the S&P 500, they're down 8%. So there's a massive disparity here where you say, well, the S&P 500 has done well. Well, the S&P 490 has done poorly. Okay, so what's going on here? We've got the top 6 tech stocks worth over $6 trillion. And this is essentially a huge disparity. So indeed, given this kind of distribution of market capitalization, you could essentially take out the industries that were the hardest hit by the COVID-19. And it really wouldn't make that much difference for the S&P 500 in terms of the total return. Okay, so again, this is a situation where certain stocks have done very well and other stocks have not done as well. So that's the first thing to understand. And this is linked to the idea of value investing. And value investing is a strategy where you buy stocks that have kind of low valuation. So think of a valuation ratio as a price to earnings ratio. So you favor stocks that have lower price to earnings ratio than higher price to earnings ratio. Well, that's a technique that's been around since Graham and Dodd in the 1930s. It's well tested. It earns a premium over the long term because it's linked to risk. It's linked to mispricing. Over the last 13 and a half years, value has underperformed growth investing. So growth is the opposite, where you're buying the high PE stocks, underperformed by 55%. And indeed, we're in a situation where if you look at the distribution of the performance of value versus growth, that value is in the 100th percentile. Okay, so that is basically, we haven't seen it in the data. That's where we are. Okay, so many people at a point like that, where you've had underperformance for 13 years, where you're in a massive drawdown. And this is not just in terms of value, but in terms of other strategies. So you're in like a really bad drawdown. It's unprecedented. And the temptation is to sell. And this usually happens. And investors make a really fundamental mistake. And that mistake is to sell low and to buy high. What we usually do is the opposite. We want to buy low and sell high. But these past returns are very, very tempting. So I guess what I'm saying here is that we need to be very careful, that it is tempting to jump on the bandwagon of these very profitable and large firms. However, beware. And an exercise that I challenge you to do is to look at the top 10 stocks by capitalization on January 1st of the beginning of every decade. So January 1st, 2020, January 1st, 2010, January 1st, 2000. So you do that and you take a look and beware. So there's other stuff going on. For example, gold. So gold is at a historic high, so $2,000. We haven't seen gold at prices like this. In terms of what I do is I look at gold in terms of a real price, so divide by the CPI level. We haven't seen this since, I guess, 2011 and in 1980. And let me tell you what happened to the price of gold after those episodes. So over the next 5 years, when gold hit the peak in 1980, it dropped by 55%. In August 2011, when it hit another peak, over the next 5 years, it dropped by 28%. Okay, so again, you need to be careful. So what is really going on here, and what is confusing is the following: that the rate of inflation that's being priced into the market right now over the next 10 years is only 1.56%. And in terms of what's going on with gold, often people buy gold because they believe that it's some sort of hedge in terms of inflation, in terms of disasters. My research on gold kind of debunks that it is an unreliable hedge. And we look at thousands of years of data. And it is a disconnect that if people are buying gold because they think inflation will go up, well, we certainly don't see that in the bond market. The bond market is not pricing much inflation. So could there be a disconnect between the gold market and the bond market? Yeah, could be. I actually believe that there is substantial risk of unexpected inflation. And it's possible that the bond market has not, they don't agree with my forecast. So that's a possibility. But it's kind of a strange situation where you see that the gold market is so out of sync with the bond market. So I just released a paper today on SSRN. So ssrn.com, and you can look me up. And it is on what is happening to the price of gold. I've got considerable research on gold. And basically, the story that I tell with my co-authors, Claude Erb and Tadas Visconta, is that one thing that is kind of different today than in 2011 and 1980 especially are the gold ETFs. So if you look at the growth of the gold ETFs in terms of the amount of gold they're holding, you see this very highly correlated with the price of gold. So again, this time might be different, and it might be essentially a bandwagon effect. And in the past, people like Warren Buffett have warned against this bandwagon effect with gold. And the idea here is that you see gold going up, and it's done very well. It's above $2,000 an ounce. And because it's going up, people jump on the bandwagon. And when they jump on the bandwagon by actually buying the ETF GLD, then that actually causes the demand for gold to go up even more. And the price continues to go up. So as people join the bandwagon, the price goes up until it doesn't. And we realize that we're way beyond where reasonable valuations are. We've seen this many times in the past. So let's kind of review the main situation. In terms of equities, we're in this strange situation where the economy is not really in a V-shaped recovery. And indeed, we've had biological setbacks in terms of second waves. It's also the case that the equity market, strangely to me, is ignoring the possibility that, or the reality, that the money that's been borrowed by the government needs to be paid back on the fiscal side. They are also ignoring the monetary stimulus and the risk that that leads to some unexpected inflation. So there seems to be considerable uncertainty, at least from my point of view, yet the Fed is basically engaged in what we call the Fed put. And that means that they, since the time of Alan Greenspan, in his famous speech in 1996, very closely watch the market and support the market. So essentially, we're in a situation where it's difficult to bet against the Fed because they do have substantial ammunition. However, as investors, and what I'm talking about are your portfolios today, you need to take a long-term perspective. I think that we need to actually figure out that this debt needs to be repaid. So on unemployment insurance alone, it's about $3 billion a workday that we're spending. So this money needs to be repaid. This is not a situation where you've got essentially free money. So we are borrowing from the future in two ways. In terms of the fiscal policy, where the government takes extra debt, well, that debt needs to be paid. In the monetary policy, we're potentially at risk of increased inflation, and inflation is not good for anybody. So on the interest rate front, the Fed has said that rates will be low for quite a long time. So if you look at your portfolio, it's pretty unattractive to buy at least government bonds, right? So the reason to buy them is just pure insurance. So if you look at the rate on the 10-year bond, it's very unattractive compared to inflation. Okay, so you need to be very, very careful there. And importantly, if there is an increase in inflation, then the price of those bonds will plummet. Okay, so these bonds are actually pretty risky in terms of an investment. And on the equity front, again, you're in a situation where if you're just thinking of the market as a whole, well, the market is really dominated by these big tech stocks. Okay, so if you're just kind of picking stocks, what you'll get if you don't hit those tech stocks is something much different in terms of experience than the S&P 500. So you need to be very careful. You need to be very careful in terms of these stocks that have extreme valuations. So the stocks that have these high valuations, we know them. I talked about the top 10 early on, but usually it's the top 6. And the top 6 are the usual names: Apple, Alphabet, Facebook, Netflix, you know the names, Amazon. The top 10 also include some other stocks like Visa and Mastercard. So in my course, I talk about the future opportunities for these different stocks. And indeed, it's kind of a difficult case to make in terms of kind of the future when you've got 2 of these stocks that essentially control over 90% of digital advertising in the US. Is that sustainable? If we talk about Visa and Mastercard, they're being challenged by fintech. So again, this is nothing new. And we could go back in history, as I said, decade by decade. And you need to be careful about that. So the one important message that I want to deliver today, it's a very simple message. And that message is to beware that you're not jumping on the bandwagon. That's very important. The idea of an investor that will be successful over the long term is to buy at a relatively cheap level and then hold. And it might be initially that you're losing money, but over the longer term, that will work out well. Of course, the other stuff that you've learned in terms of diversifying your portfolio, I'm taking that as a given. So what I'm saying is just be cautious. Yes, it is time to re-examine your portfolio. Given what's going on, it would be ill-advised not to re-examine your portfolio. We're in a historic disruption in terms of the economy, and you should take that into account. You wonder where the safe havens actually are, and I will tell you right now that gold is a very risky safe haven. So my research suggests that it's unreliable. Anyways, it's historically expensive, so be careful. Safe havens as a bond, well, it's not so clear because those bonds have very low interest rates, and if inflation goes up, then you're going to be hammered. Equity markets, well, they're overall in this puzzling position that I already mentioned, but there could be within the equity market some opportunities. Of course, there are other assets that are available that are more difficult to deal with, such as real assets, like real estate. There are many assets that are attractive to large investors, like institutional investors, where they can invest in private equity. Very difficult for individual investors to actually do that. It's also attractive to invest in hedge funds. But again, these opportunities are not available to the average investors. A hedge fund might be long and short and immune to a substantial market correction. But those are difficult to actually get a piece of. So again, it is time to re-examine your portfolio. The options are fairly limited, but there are options available. Okay, so I talked for a little longer than I wanted to. I definitely want to talk about some questions that have been asked. So I'm looking at the questions, right? And the first question is from Abi, who's an alum, and he asks about the disconnect between the Dow rally and the actual economic state. So again, I've talked about this already a fair bit. The stock market is pricing a V-shaped recovery. That's what they believe. Like I believe the recession will be short, but it's just unlikely to be over so quickly. There is some permanent damage, and I think that there's a lot of optimism, and people just want to believe this is going to end, and it will end with the deployment of a vaccine, but there still will be some damage. So the question is why? And I think that at this point, given what we've been through, any green shoot, a lot of weight is put on it. So there's a question about job market and finance and private equity over the next year. I actually think the job market and finance is going to be fairly robust. And again, this is way different than 2008. The global financial crisis really crushed the finance industry, and jobs just disappeared. There was very little. And in the finance industry, people basically moved into consulting and other types of jobs. And it was a long time before that came back. However, it's different today, especially with the rise of private equity. And I think that it's not going to be 2019, but I do think that it will be way better than other industries. So again, this crisis has disproportionately affected different industries. So, the food and beverage industry just really, like hammered. Whereas the finance industry and certain technology industries have been relatively immune. Okay, so there's another question from Corey, who's an alum, and basically asking about cryptocurrency. And again, crypto is supposedly a safe haven. And we've certainly seen a lot of interest in blockchain technology. Indeed, that's what I teach. I teach a course called Innovation in Crypto Ventures. It's a very balanced course in that we look at risks as well as opportunities. Cryptocurrencies, I said that gold is an unreliable hedge. So gold has got the volatility of the S&P 500. So it's really unlikely that you can rely upon a hedge that's that volatile. Well, cryptocurrencies have the volatility of 4 or 5 times the stock market. In addition, we've only really got good data since 2011. So we don't even have a decade of data. We don't even have a recession. Well, actually, we do now. And actually, if you looked at what happened to cryptocurrencies in the worst month of the COVID-19 crisis, they dropped very substantially. So they dropped by over 35%. Okay, so again, you need to be careful. Yes, it's exciting. I would much prefer, instead of just speculating on Bitcoin or Ethereum, to invest in a token that's linked to a good business idea, like a governance token. So that's what I would do. Again, don't count on that for a hedge, but it might be a good investment opportunity. Rodrigo, who is a current student at Duke University, asked about the Fed and further unconventional tools. Well, the Fed's already said that they're going to do unlimited quantitative easing. So who knows what's going to happen there? We've never been in this situation. So Bernanke in the global financial crisis did quantitative easing, but there were distinct limits on the quantitative easing. So could the Fed go even further in increasing the balance sheet? Yes, they could. And to me, that just increases the risk of unexpected inflation. And to be clear, unexpected inflation is bad for the economy, is bad for business. It's especially bad for the more disadvantaged in our society. because inflation's a tax, and they pay that tax at a much higher rate than others, given their spending. So I think that we've seen essentially 90% of what the Fed can actually do. Could there be some surprises? Yes. For example, a surprise could be that somehow the Fed starts buying equity directly. They're already in the ETF market. So other central banks do that. I think it's a terrible idea, but there could be some temptation to actually do that. I don't think it's that likely. So I've got another question from Jerry, who's a current student, about the trend in Robinhood investors. So Robinhood is this tool where it's extremely low cost or zero cost to actually invest with them. Let me just first say that what I just said is false. So the fee that you pay might be zero, but you're paying indirectly in that the prices that you're getting for what you're buying or selling are not that favorable. So there's a cost that is hidden, and we talk about this in my course. So again, be very careful here. Look, it's very difficult to pick stocks. So I consult with some very prominent firms, and we have teams of people and machine learning tools and computing resources that make like IBM Watson look like an iPhone. Okay, this is really difficult. And if you think that you can consistently beat the market by spending like an hour a day day trading, I think you're wrong. Okay, so again, this is what we do in my course also, my investment course, but just beware. And again, given the market is in a trend going up, you can be fooled. Well, yeah, you're making money, but will it sustain? So you need to be, again, very, very careful here. It looks good, and to speculate like this, if it's not your full-time job, beware. So I got a question from Doug, who's an alum, and this is an idea about the influence of emerging market debt, and does this overhang really affect US and European firms? So the idea of debt overhang, let me just detail that first. And that is that you've got so much debt that even if your company has a good idea, then you can't finance it. Okay, so I've talked about this as one of the major risks to the recovery, that many firms have gone into debt. And this is not just a US phenomena, but around the world. And yes, I actually do believe, Doug, that you're correct, that this will be a force to mute the recovery. So remember I said that it's unlikely we get back to where we started with. So I can do one more question. And look, we're collecting these questions. And if you repost the questions on my LinkedIn, I will try to get to them. So, the question is, you suggest that inflation is a risk, but do you think it is inevitable given the amount of money that's been poured in? And the answer is no. And let me tell you why. So just because money is created doesn't mean inflation exists. Okay, this is really important. There's this identity called MV times PQ. So money times velocity equals the price times the quantity. And people think, well, if you double the money, then you double the price level. No, it depends on the velocity. And think of it in a simple way. If there's a helicopter drop where everybody all of a sudden gets double the cash they had, will that double the inflation? Well, yes, if everybody just went out and spent it, but no, if you put it under the mattress. And that's essentially what's been happening. The equivalent of under the mattress is the excess reserves. So the Fed holds these huge excess reserves. So if those reserves get out, so if the Fed stops paying interest on those reserves, then that could cause a surge in inflation. So it's not inevitable, but the bigger the balance sheet, the bigger those reserves, the higher the probability that there'll be some inflation leakage. So again, not inevitable, but probable. Okay, I need to sign out now. Thank you for all these questions. Again, you can load them into comments on my LinkedIn and follow me on LinkedIn. And I wish I had more than like a half hour to do this. Next week, David Robinson is going to return, and he is going to talk about something I talked about a little bit, and that is the possibility of getting private equity into 401k plans. So definitely tune in for that next week, same time, same place.